here.
The company achieved
Okay,
another
let me know in the chat
milestone
if
in
you can hear
March
this.
by joining the S&P Small Cap 600 Index. And maybe just for those that might be less familiar here in the audience, could you discuss the company's evolution over the past 5 years?
Yeah, happy to. Thanks for the question. We were born as an energy company. Zach and I founded the company together, and we built a portfolio of.
So really quick, I'm going to pause this. This really sucks. It was supposed to be live, but this looks like it's a replay. So, oh well. I might put it on like 1.25 speed if I can. Let's do one. Let's do 1. Let's see what 1.5 looks like. I'll take notes throughout this and I'll chime in.
Of patents and IP surrounding distributed energy resource management systems. So think energy generation plus energy storage. But what was our secret sauce was the basically the control mechanism. So we worked with military, industrial, and commercial clients. So for example, at Marine Corps Base Camp Pendleton, we built microgrids that served mission critical loads, meaning navigation, guidance, and communications. We had both the infrastructure, energy storage, energy generation, but also the control platform that enabled that to stay live regardless of what was happening with the grid. So, you hear a lot about the instability of the California grid. So we built a system that would allow those missing.
Yeah, I'm going to save us some time. I have it on 1.5 speed, and somebody said that's a good speed right now. What he's talking about right now is kind of fun, because that's actually when I first invested in CleanSpark, when they were doing this business. So I'll resume this.
Mission critical functions to work even in an extended period of energy disruption. So we then built a supporting control platform that operated under certain vectors. So if a commercial client wanted to use our system and avoid peak energy costs, they could use that software and it would do peak shaving and load balancing. But then we evolved it further and developed an open, a virtual top node, virtual end node communications protocol. So long answer, but it makes sense. In California, if you participated in demand response at an industrial level, you used our communications protocol. So we were really about enabling large power users to minimize their cost exposure and maximize the resiliency of their operations. So learning about the opportunity that Bitcoin presented it seemed like a really natural fit. And after we grew one of our immersion cooled facilities, there was a journalist from Axios that came, and Axios has historically not been very pro Bitcoin, but Brady Dale wrote an article and he said, what differentiates CleanSpark is that rather than being a team of Bitcoin bros trying to understand energy markets, it's a team of energy professionals iterating in the digital asset space. So we feel like that was our jumping off point, and that's kind of where our differentiation started. And we feel like we've grown it since then.
Great. And as you derive 100% of your revenue from Bitcoin mining today, I'd like to just maybe talk a little bit about the total addressable market around aggregate mining revenue first and the drivers there before going into some company specific questions. We've seen growth in aggregate mining revenue over 23 and 24. It's still slightly down from the 21 peak. Obviously you have the block rewards revenue, and then you have the transaction fee revenue side. So maybe just high level talk about how you kind of see aggregate mining revenue and that TAM over the next 5 to 10 years.
So the beauty of the network is everybody knows what the new Bitcoin produced every day is. I mean, it's 450 no matter what, right? So with the kind of the variability, the question being, what percentage of the daily revenue can you derive from block rewards? It's really a function of a multitude of different questions, but really it goes back to adoption. So with the new administration, we're seeing greater adoption. So if you were to create a chart and you were to chart the growth in adoption, Bitcoin price appreciation over time, the regulatory environment, and I guess maybe the energy relationships, each one of those charts would go up into the right. So we've taken a long-term view by building energy first. We feel like what's going to be the differentiator as difficulty continues to go up, a larger number of less efficient miners are forced to unplug, which organically grows our share of the Bitcoin network. And as we continue to reinvest to make sure we have the most efficient fleet and the best or among the best, most competitive energy prices, we feel like it'll be a continued differentiator. I mean, if you look at our last Q, we have the lowest SG&A of any miner in the space. We really focus more on austerity and ensuring that we're making the decisions at the right time that support the best return, being the, I guess, highest possible stewards of investor capital.
Great. And maybe on just Bitcoin, I mean, over its history, right, it's only experienced one sort of MBER defined recession, right, which was in 2020 during COVID, and it was very shortest I think recession on record. And just given there might be some risk arising today, obviously things were positive, but some concerns around potential recession risk and so forth. I think Polymarket has higher odds there. How do you envision Bitcoin price sort of performing in a recessionary environment?
The answer to the question would be entirely different if we were talking 12 months ago. I think the 4-year cycle pricing is somewhat broken, but more importantly, if you go back for the last 10 days since everything started with the tariffs and the global financial markets in crisis, Bitcoin has significantly
I've
outperformed
never
the
agreed
seven
with the
and every other group.
four-year
So I think we're
cycle.
starting
No
to see a
market
paradigm
is
shift
perfectly
that
predictable.
Bitcoin uniquely,
People
it didn't translate to Ether. It hasn't
tops and the
it hasn't-
bottoms,
there hasn't
rendering
been
it
a correlation with
perfectly
other
unpredictable.
digital
So that
assets,
four-year
but
cycle
Bitcoin
thing,
seems to have begun a pivot
complete bull
from
crap.
a risk-off
Called that
asset
out,
to more of a
like, a year
risk-on
ago.
asset. And so to see that, it kind of brings full circle, I think, the vision of what Bitcoin could ultimately be.
Great. And one more sort of on an industry look on hash price, right, with the interplay between aggregate miner revenue and network hash rate. You've seen that decline pretty significantly through each halving cycle. And I'm just curious to ask you. I talked to your team. I had the privilege of meeting a lot of your team yesterday, which was really nice. And Taylor, I've asked the question, right, and they said they don't think so. But I'm curious to get your view around. Do you think that that trend of downward in each halving cycle continues over time, or do you think you can see some stabilization, whether we get some activity on the transaction fee side or so forth? Curious to hear your views here.
So, I think it's going to be a challenging environment for the space in general, just because it is so CapEx heavy. But I think what we're seeing is many of our peers have started to talk about other lines of revenue. We're HPC AI, we're zero cost power. We're going to start dabbling in other markets. What that ultimately means is, and I had an opportunity to do a podcast with a guy, DR Lewis, and we talked about that. Kind of the old story, right? Two guys asleep in a tent, and a bear comes wandering into the campsite, and the one guy starts to panic, and the other guy puts on his shoes. The first guy's like, "Why do you put your shoes on? You can't outrun a bear." And he said, "I don't have to outrun the bear. I just have to outrun you." And that's kind of the way we look at the Bitcoin network. If we have among the highest, so there are really 5 factors in Bitcoin mining that we look at. It's total hash rate, uptime, fleet efficiency, Bitcoin HODL, and what's the other one I'm forgetting, Gary? It doesn't matter. But the point is, we've never endeavored to be number one at everything. But what we've always focused on is making sure we're one of the top 2 or 3. So if I have the highest uptime, which I think is what CleanSpark has long been known for, and if I have the number 1 or number 2 most efficient fleet, and we're one of the 2 or 3 highest liquidity stocks, so we have access to capital, we have a really strong balance sheet, I think that begins to be a differentiator. And what we're seeing more and more is many of our peers are looking to focus elsewhere on stable revenue streams. And I think that only benefits us long term. So, the knock that you had the opportunity to go in yesterday, for a lot of our peers, forever this business was asset light versus owned and operated, and there was an argument either way. And now it's, are you AI or are you a pure play? But the argument for asset light versus owned and operated is the flexibility and the autonomy that we have with regard to our operations. So when you walk in the knock, you can see energy prices in real time in all of the jurisdictions in which we operate. You can see ambient temperature and relative humidity, which on facilities that are air cooled, that becomes a factor. So if you were a asset light model, you take your computers, you drop them off at a data center, and you say run them, they plug them in and operate them. Ours aren't, it's not so much an on-off switch, it's more like a rheostat, right? You can turn them up a little bit, turn them down a little bit. So we can modify the performance of our fleet based on environmental and economic conditions. So that's a huge differentiator. And the guys you met, Taylor and Tyler and the team of professionals that they have, the cool thing for us as a management team is we've surrounded ourselves with much smarter people when it comes to those specific technology skill sets and operations. So they have the ability to get more juice out of the squeeze. They can operate more efficiently. And as that separates us, we're now one of the 2 largest Bitcoin miners, and we have more domestic hash rate than I think anybody else. And what that's enabled us to do is to be more efficient and to produce at a higher level, more Bitcoin per exahash, more exahash per megawatt than many of our peers. And aside from that, we talked briefly about SG&A. We have 31 data centers and almost a gigawatt of power, and we only have 300 employees. You compare that to many of our peers, and they have double that headcount. So being able to be extremely focused and efficient on what we're doing and not chasing shiny keys kind of offsets the volatility in hash price, because it's really a function of what everyone else is doing. And as long as we control what we can control, I think we win.
Shiny keys.
The mining industry is consolidating, yet remains fragmented globally. You talked about your leading in domestic hash rate in the United States. You are the largest United States Bitcoin miner. We estimate your market share grew from around 0.4% in 21 to now slightly over 5% in Q1. Public miners, I think in the aggregate, account for somewhere over 30% of the market. You have China and Russia miners that are probably also represent a significant slug. Maybe just discuss, why does CleanSpark prioritize scaling U.S. operations, and how do you see market share trends and consolidation evolving during this halving cycle and after?
So, we've been pretty acquisitive over the last few years. We bought the assets of one public company, Mawson Infrastructure. We did a public-to-public transaction with Grid. We've continued to buy a lot of sites that make sense. We've analyzed and investigated opportunities in South America, in Africa, even in Europe. And if I could, just take a little bit of a segue and talk about a differentiator. When we rang the bell, they did a kind of a show and tell video about CleanSpark. And we had a film crew go to this little town in Sandersville, Georgia. And the mayor sat down to talk about the impact that CleanSpark's had in their community. So 50 years ago, Southern Company goes bankrupt. 49 small communities throughout Georgia each sell a bond. They make their investment in this new Plant Vogtle nuclear power plant. Now, 50 years ago, a lot of these small communities had timber mills and manufacturing and heavy industry that, our country's done a pretty poor job of maintaining that. We've offshored a lot of that. What that means is these little municipalities have pockets of power that was allocated to them, and it's less efficient to transport that power. And additionally, like for example, in Georgia, a lot of we have a ton of hash rate there, a lot of megawatts. I think we're, 20% of the MEAG network. That if the state of Georgia exports that power to Florida, like they do, those municipalities that bonded the construction of Plant Vogtle receive no benefit. So what we did is we designed a relationship where rather than focusing on, I need fixed cost power and you have to sell it to me at that, what that does, we saw from the last time the cycle went bad, it puts utilities and hosting companies at risk, and it becomes an existential threat. So instead, what we negotiated is a fixed power agreement where we pay their absolute cost for power, and then we allow the cities to make a little margin.
All right, really quickly, I want to make a point here. You mentioned how host providers it's kind of an existential threat to host providers. What he's talking about is when you're a host, you guarantee uptime to your customers. So you guarantee 99% uptime, and that energy cost, if it goes up significantly above what you charge your customer, you're actually paying more for energy at the end of the day than you're taking in via fees from your hosted miner. So that's kind of what he's talking about. We saw that unfold in 2022, where there were a lot of hosts that went bankrupt because they guaranteed uptime at a certain price per kilowatt hour for their customer, and their own energy costs rose above that price per kilowatt hour. Anyways, we'll get back to this now.
So that means if power prices are up, we make the economic decision whether we're going to curtail or underclock or remain the status quo. And so what our operations do is we manage to profitability. We don't manage to an energy price. So Jimmy, the mayor of Sandersville, Georgia, sat down with us at a diner, and he's telling the guy on this show and tell video, he said, I've been between city council and being a mayor, I need to have my head examined because I've been involved for 44 years. And for 42 years, we ended every single fiscal year in the red. He said, for the last 2 years, we've ended up with a surplus. And he talks about the splash pads and the walking trails and the bike paths and all the things that they built, because in the state of Georgia, the margin on those revenues stays in those communities. So he then had an opportunity to be interviewed by an Atlanta TV station because sales tax on utilities also stays in the community. So now they've created this surplus in sales tax, and it's very specific how it can be allocated. So we've not only allowed the citizens of these communities to participate in like the Costco model of buying power, but we've created this surplus. Not only are we're growing and developing and improving the communities, but the sales tax has now created this surplus. And in the interview with the Atlanta TV station, they said they have no choice but to apply it to property taxes in the community. So really long answer to your question, but here's why. Those 49 mayors, city managers, economic development directors get together 4 times a year to talk about strategy. That kind of information doesn't remain in a vacuum. It gets shared. And so the mayor of Sandersville is friends with the mayor of Washington, is friends with the mayor of Dalton, is friends with the mayor of pick a city. And these small communities are now saying, hey, can you do that here? And the differentiator is that we have greater favorability in those transactions than, say, a hyperscaler might, because the expectation of power that's up to 99 and 5/9 puts an unrealistic burden on the community to fill and to meet the terms of those MSAs. So we said, hey, we'll be the first guys to shut off. So when the hurricanes hit the little city of Washington, Georgia, we have 86 megawatts there. The town was named after the president of the country when it was founded in 1780. The city hall, the foundation, there's a historical marker in that foundation. That's the same building exists today where they signed the documents that abolished the Confederacy. These are really rural, really blue collar, not sophisticated towns, but they have access to power and they just want somebody to treat them fairly. So when you go in there and you create the relationships like we've done, it becomes contagious. So why would I have the counterparty risk of, popping up a facility? Eric Trump spoke earlier about, they're using surplus power in the wintertime to mine Bitcoin in the Emirates. Counterparty risk. Let's talk about that from an analyst perspective. If I have a disagreement with my operating partner in the Emirates and it's a sovereign wealth fund, to whom do I litigate that matter? And what are the likelihood that I prevail? So what I know about doing business in Wyoming and Tennessee and Georgia and Mississippi, and as we continue to grow throughout the country, these relationships are a win-win. And so there's pull-through demand. We get invited to come into the city. But, I have a team of professionals that works with me. Nobody goes and knocks on doors and asks, can we come there? People invite us to come do what we do there.
That was great. And maybe just touch on again, I'm going to ask you again, just on how you see sort of the market concentration and market share is sort of evolving. I mean, you think we have, more or less public miners, in 2028? Do you think, let's start there.
Yeah. I think the number decreases rapidly. I mean, Zach talks about the fact that 3 of anything is the right number. You look at big companies, and everybody can name the top 3 manufacturers of TVs or automobiles or cell phones. But once you get beyond that, it starts to get confusing. This business is about access to capital. So as the spreads increase, where they're the top 3, and then everybody else is kind of an also ran, a lot of the companies that aren't the biggest, that don't have the liquidity, that can't do a 0% bond, that can't, raise capital in that same way, that don't have a balance sheet, they're now talking about AI. They're talking about other things. And I think that consolidation, what really happens, we heard the Trump family talk today. They're working with Hut. Hut sounds to me like they're going to step away from the Bitcoin side, focus on the HPC AI. And one of the things they discussed on your panel this morning is that they see their stack of Bitcoin as capital to grow the AI business. That's great for them. I think it's a wonderful opportunity. If they can monetize those megawatts, then absolutely more power to them. What that means is the companies like that are looking to remove the mining assets from their balance sheet, because look, we have just under a gigawatt of power, 1,000 megawatts, and there's some Digital Realty has 1.2 gigawatts. I have a $2.5 billion market cap. They have a $90 billion market cap. So when you look at the disconnect between valuation, the companies that are looking to pivot or are trying to straddle that fence, they're really looking to kind of divest of the Bitcoin mining assets to focus more on AI. So I think there are fewer mining companies. I think that creates greater opportunity. It increases organically our share of the network. And, I think the US government is going to continue to focus on domestic hash rate, because just like the SWIFT system, if hypothetically there are OFAC restrictions on block space, if there's not block space in the US, all these US companies now are challenged with access to the blockchain. So I think it becomes a matter of national security that the US has predictable, secure Bitcoin block space. And I think that gets narrowed down to the top 2 or 3 guys, and everybody else continues to chase other opportunities.
One more on this. Do you think that increasing concentration comes from more M&A or attrition?
I would say C, all the above. There are companies that, we meet with private operators all the time, and, they have a fleet of, blend of S17s and S19s, and they have cheap power and they continue to operate. But, they had a $20 million CapEx investment 5 years ago. And the question is, do we take the profits that we've had? Do we sell our infrastructure to somebody else that's going to refresh the fleet? Or do we go deep on debt and try and duplicate it again? And an increasing percentage of those small operators are calling companies like CleanSpark and others and saying, hey, what are my megawatts in infrastructure worth to you? So I think it's going to be a combination of both. I think you'll see more continued acquisitions. There's some big players in the space that have made it abundantly clear they're not going to grow hash rate anymore. They want to talk about compute, but they have assets and rack space that are valuable for Bitcoin mining that maybe not so much for HPC due to latency or geography or whatever the case may be. And those are relationships and calls that we receive on a daily basis.
The Bitcoin mining industry, faces challenging economics due to its global competition, capital intensity, commodity-like revenue streams. Many competitors, as you just mentioned, matter diversifying into high-performance computing, co-location, or attempting to. CleanSpark operates, I think, 29 owned and operated data centers at the end of Q4. Why does CleanSpark maintain its focus on Bitcoin mining? Let's start there.
So you had an opportunity to meet Taylor. We get inbound solicitation all the time from companies, hyperscalers that are interested in what we do. And the argument has always been the same. If you look at what your revenue is per kilowatt as a Bitcoin miner, it's X. And we compare it to what the MSA would call for on a relationship with a hyperscaler, it's Y, and there's a differentiator. And if you look at it on its face, it's like, okay, if I'm currently making 17 cents a kilowatt hour and a hyperscaler is worth 24 cents a kilowatt hour, why would I not do that? And if you consider it from the perspective that you're only looking through a fiat lens, then it would make more sense to pursue those relationships because the ROI is better. But if you look at the value of our kilowatts from 2023, when we were mining Bitcoin at a 55% margin and Bitcoin was, $60,000 just a year ago. So my cost to mine it is at $20,000, and now I have 12,000 of those Bitcoin on my balance sheet, and I've got all that appreciation of that value. You have to factor in what's my real return on those kilowatts compared to something else. And as we see a significant increase in competition for the hyperscalers, there's a couple of models, right? Do you do GPU as a service? We have peers in our space that went really aggressively at securing megawatts, and they're now talking about GPU as a service and spent tens of millions of dollars on H100. Well, rental on an H100 1 year ago this month was $8 and change per hour. H200s are out, and now Blackwell, so H100s are antiquated. So the Moore's Law cycle is accelerated in GPU service far faster than in the ASIC space. But what that really means is now you've got all this CapEx invested in assets that it was $8 an hour, now it's now $1.25. What's the ROI for my shareholders? What's the cap call necessary to refresh that fleet? And at the end of the day, if my power contracts really don't provide that 99 and 5.9 uptime, am I really attracting a creditworthy tenant in these relationships? So for us, it's a measurement, kind of like talking about international expansion, really heavy measurement on counterparty risk, analysis of the long-term return on investments, and then using technology that we have at our disposal to maximize the value of what we have, and doing what we know best has just been, it's been justification for our focus. Now, never say never. We deployed 75 megawatts of immersion cooled facilities from the time we bought the facility, scraped it to the ground and started over. We were hashing in 6 months. So that attracts a lot of attention from hyperscalers saying it's a 5-year process for us. How could we, collaborate, work together? So we see those opportunities, but for right now, at least today, the measurement is that we're gonna focus on what we do best.
I think CleanSpark. You've often spoken your team around on differentiation, right, versus your peers. You often talk about operational excellence and your capital stewardship. So maybe just, I know you've been discussing this as we've been talking, but maybe just put some finer points on maybe those two areas and why you view your company as this differentiated miner.
So 80% of our growth going forward is immersion cooled. We've secured the entire supply chain of that equipment. It's quieter. It's almost a set it and forget it, with the exception of the firmware that we make those adjustments regarding global market conditions. But by focusing on that, focusing on uptime, we believe that we're, I don't mean to sound condescending to the industry, but we're trying to be the adult in the room. I think the days of, hey guys, guess what? It's a new $2 billion ATM, but it's not bad news for you. Investors have become really weary about that. And so
bet,
to have $2.8 billion
100%.
in assets on our balance sheet, $1 billion of which is Bitcoin, $650 million in
100%.
long-term debt at a 0% coupon, we have a lot of flexibility that many of our peers don't have. You had the opportunity to meet with our digital asset management team. And I think after that meeting, if you didn't come away from that with a pretty strong thesis that this is a pretty adult way to manage these assets that maybe hasn't been considered before, we look at it that way. We look at non-dilutive forms of capital for continued growth. And I think it's only a matter of time before the institutional investors kind of recognize that. Recently there were some 13Ds that came out that BlackRock is now 15.5% holder of CleanSpark. Got a lot of feedback, both retail and institutional, but the single biggest component that people reached out to our team and complimented us on is in that entire quarter period, CleanSpark's issued and outstanding shares grew by 0. So it shows that by being disciplined stewards of capital and having a focus on returning shareholder value, it may not have resulted short term in the best price appreciation. But if you look, we talk about this in the office, and it's a bad thing to say, but we're the least bad. I mean, year to date, we're down, but we're not down nearly as far as many of our peers, and especially some that have kind of bet the farm on focusing on AI operations.
In February, a major peer suggested that many grid-connected miners may struggle to remain economically viable after the 2028 halving. CleanSpark operates with a mix of grid-connected power agreements, as you know, Matt, including variable and fixed contracts across its facilities. Notably, I mean, we estimate CleanSpark has the second lowest hash costs. This was as of Q1 25. In our coverage, and maybe just address sort of, and you have obviously above average than peer fleet efficiency.
Talking about
just address sort of the concerns about economic viability and future halvings, and maybe discuss how fleet efficiency and energy costs will play into those dynamics.
Sure. So, as Bitcoin miners, we fancy ourselves as really sophisticated, so we have to use joules instead of watts, which is normal English vernacular. But you look at the measurement of our fleet. Now, last quarter we were 17 joules a terahash. What that means is, for 1 terahash processing power, we consume 17 watts. The average of the fleet a year ago, the vast majority of the public miners, it was in the high 20s, low 30s. So, smaller operators that have a higher fleet efficiency, it costs them more power to do the same amount of processing. So when you combine that with basically kind of escape velocity, which is where we see ourselves, and that is that we've reached a tipping point that we can choose to continue 100% HODL strategy, or we can start to use the Bitcoin that we mine, that we have tremendous margins on, to sell that Bitcoin or use that Bitcoin in a digital asset management strategy to generate income. So we're not strictly tied to leveraging equity for continued growth. And I think that the fleet efficiency question is really relevant, because the companies that are talking more about AI aren't making the CapEx investment in the new, like we just in order to get to 50, we exercised part of the option we had from Bitmain, and we've got, I don't know, several $1 million worth of machines coming that are 13.5 joules a terahash. So those will arrive, and that'll drive our fleet efficiency even lower. And so we're now kind of less impacted by energy cost and by Bitcoin price, because it kind of locks in our margins. And when you add that to 99.8% uptime, it gives us kind of a distinct advantage that, the guys that are talking more about AI are content with 22 joules a terahash or 23. And as those fleets kind of age out and there's another refresh, it's, I think, increasingly likely that many of those operators focus more on other revenue streams, because the cap call is just too big. So, to my point I made earlier, I think organically that grows our share of the global hash.
That was a big
We track
statement.
cash
focusing on
SG&A as a percentage of
potentially
revenue
selling
across
some
the industry.
Bitcoin,
And in 2024,
or
CleanSpark had the second lowest
yielding
average quarterly
income from their HODL balance
cash
to
SG&A among our
finance the
coverage
business
on
and
a
its
percentage
growth.
basis.
So that's
You're
something
guiding
I've been
towards more,
focused on this YouTube
modest,
channel and
cash
my
SG&A
bull
growth in
thesis for the company.
2025.
But Matthew
And can you
Schultz
discuss,
has kind
how
of
CleanSpark plans to
verbalized
maintain
that as well.
sort of this lean
Very
cost
big deal.
structure or leaner cost structure as we go forward, and keep cash SG&A growth muted?
So, back to the comment I made about the austerity, our board, we had our entire board fly in town this week, and they have a different approach. Like one of our lead directors spends his normal job in a bunker with the nuclear button in Hawaii. PhD, very analytically minded guy. One of our other directors is the chairman of a chain of credit unions. And so when we make decisions that are material, the way that Gary and his team present this, we have to have an expectation that costs are continually being managed. So it's simple things like, managing our headcount and keeping our benefits in check and being prudent with the use of RSUs and PSUs as an incentive, being mindful of those other operating expenses that can run away. Now, we've had a couple of quarters where there were some outsized stuff, legal or whatever the case may be, during big M&A that's kind of an outlier, but having a focus on that has been a differentiator for us, and it's definitely impacted our financials. And I think, we see the growth of the institutional investor base on our stock. It's now, close to 60%.
That is a huge deal.
You have to believe that
the reason
the exodus of retail investors is being offset largely by the inflow of new institutional investors.
Cash salaries or their cash
kind of
bonuses is because of the
PSUs,
RSUs,
really comes down
the
to being
stock
mindful and
options that
disciplined.
they're issued
in some of those meetings
as incentive pay.
If you at a conference or a trade show on an earnings call, you're going to see all of our team locked arms and smiling and happy, and everything's like the Brady Bunch. But in some of those meetings in our office, doors get slammed and voices get raised, and people advocate very passionately about a position and why. And we've matured as a management team to the point that we can hear and analyze these arguments and perspectives and then make an informed decision rather than a knee-jerk reaction, which I think is why we've remained focused the way we have.
Big topic of conversation these days are tariffs. CleanSpark sources its mining rigs from Bitmain, manufactures them, I think, primarily in Southeast Asia. In your March update, you mentioned that the newly announced tariffs might temporarily increase industry-wide growth cost. Obviously, it's a fluid situation, but maybe you could just elaborate on this impact and how CleanSpark is positioned to navigate these challenges.
Yeah, one of the things we talked about recently in the news was that we've onshored the vast majority of what we need to get to 50. So, we were joking earlier that with the 90-day postponement of tariffs, it's almost disappointing. And I know I'm saying that tongue in cheek, but we've created a bit of a moat because we've got the scale and we have the machines that are already onshored that will continue to allow us to separate from the balance of our industry, to increase our efficiency, scale up our hash rate, to continue to pad our balance sheet. And so we look at it generally favorably. It's kind of cool that, a lot of the manufacturers have already begun to spin up operations domestically. One of the manufacturers of miners, in fact, one of Riot's suppliers, they've begun to import a lot of equipment, a lot of the components, and they do the bulk of manufacturing on certain model numbers domestically to circumvent that. So it's a win for everybody, right? I mean, the whole idea behind the tariffs is to strengthen the base for U.S. workers. It's a painful pill to swallow, but I mean, if today's pivot was an accident, I'd be surprised. I quite frankly think that the president took a mess around and find out approach rather than threatening we might do this. They threw everything at it. The financial markets cratered, and according to what Besant said on TV today, 75 countries have reached out and said, hey, how can we make nice? So I think ultimately it benefits our country. For CleanSpark, I think it's a negative, probably a neutral point, because we do have so much onshored already that it maybe negates some of the moat and the lead that we have, but we're prepared to manage around it because it's going to impact everybody the same.
Are you in a position yet to quantify any impact on the tariffs, or is that still just fluid? And in terms of price increases or anything around shipping costs and stuff like that?
Well, Bitmain does its worldwide digital conference every year towards late fall. They've just announced that they're going to accelerate that. It's going to be the week after BTC 25 here in Vegas, which generally means there's a drop of equipment. They're highly profitable. The Bitmain could absorb a significant amount of the tariff impact in order to continue their dominance in the space. And I think it's probably likely that they're looking over their shoulder at some other manufacturers that are going to threaten that 13.5 joule per terahash machine that we're most recently buying. And so, before anybody said, hey, us too, I think they're kind of a step on the neck kind of approach.
Management has emphasized the long-term margin benefits of increasing scale. You achieved 42.4 exahash in March. You're aiming to get to 50 exahash by the end of Q2. How does sort of the current weaker hash price backdrop influence your plans for scaling beyond maybe 50 exahash? Could you compare and contrast maybe your approach to scaling in both bull and bear markets? Thank you.
Yeah. So during the last bear market, when Bitcoin was under a tremendous amount of pressure, a lot of our peers, Bitmain launched the S19 XP, and that was revolutionary. A 144 terahash machine, much more efficient, and they were selling it at the time in that $80 to $100 a T threshold, and a lot of the Bitcoin mining space, smaller players, kind of FOMOed in and placed those orders. Well, the way our industry works is you put a deposit on this equipment and you get delivery 2 or 3 quarters later. So what happened to the price of Bitcoin between the peak in the market when everybody was FOMOing into these orders and when they started to onshore and arrive, the price of Bitcoin had fallen out. The guys that had levered up were now facing margin calls or were capital constrained and couldn't pay the balance of these rigs. So CleanSpark bought tens of thousands of rigs that had been pre-ordered at $80, $85, $90 a T. We picked those up at $15 a T for the same machines new in boxes. So it's kind of counter-cyclical. When we bought the Washington, Georgia facility, same thing. They blew through a couple of opportunities to curtail, and really smart, really nice guys, but they got so far behind that they were paying their power bill in cash daily, and it wasn't sustainable. So we acquired some of these facilities. We use our balance sheet to be able to bond those deposits, so it's not tying up a bunch of cash. So I think that strength that exit velocity that we talk about has begun to pay more dividends. And the idea that we're not afraid of countercyclical growth. In fact, we focus on it, and we feel like it's really been advantageous for us. So I think, regardless of the time, we've secured the right machines. I mean, we have machines options up to, I think, 63 exahash at the lowest prices they've ever been imported in the country. And the beauty is, being Bitmain's largest customer right now, if and when at WWDC they drop a lower price, we have the ability to flip that option into the newer, later, greater stuff. So I think it just continues to drive the separation between, industrial scale, highly efficient, low leverage operators and everybody else. And I think it creates opportunities for, kind of accretive M&A.
Great. Investors have asked, me, how CleanSpark plans to fund growth beyond 50 exahash. Historically, the company has relied on equity capital markets. And in December, you raised the 650 million zero coupon converts. You have I think your current fair value of the Bitcoin HODL, debt to the fair value of that is roughly or close to 70%. That was before going into today. So, what is sort of CleanSpark's appetite for taking on additional debt to support growth here? And, would you consider establishing another at the market offering at some point?
So, we have not used equity since November of last year. We've been really clear on messaging that. We don't feel like, we think an ATM is a tremendous tool when valuations are outsized and you're really receive a premium in your value. There was a period of time that we were trading at a premium. It made terrific sense to use a 2.5% instrument to pull down equity capital. Under the current valuation, like I mentioned, $2.8 billion in assets, and $1 billion of that is Bitcoin. To draw down equity when you have, a $2.2 billion market cap doesn't make sense. So what we've talked about and what Gary has, slammed the table and stomped his feet about is non-dilutive equity or non-dilutive capital. So, Gary and I do dozens of calls with different institutions on a weekly basis. And, the market is starting to open up to the concept of baby bonds, and rating agencies are more favorable to disciplined Bitcoin mining companies. We've had opportunities to do another bond. We did 650 million at 0% coupon price, convert up 100. And we paired that with a share buyback to kind of offset the hedges that bought into that. But we've now had opportunities to go back in and do another convert, and maybe has a 1 or 2% coupon, which cost of doing business, it just makes sense if we can deploy that right. And what we did different, Bitcoin was what, $79,000 this morning, and in the same period of time that we did a bond and we chose to buy equipment to mine Bitcoin at 34,000 a coin, a lot of our peers went in and bought Bitcoin at 108. So you look at, yes, we have 12,000 Bitcoin on our balance sheet, and on BitcoinTreasuries.net, that's the 4th biggest in the world of any public company, but we've mined every single one of those. We didn't buy one. So fear of market pressure and potential margin calls and the overarching concerns that may exist when you lever up to do that really don't apply to us. So I think our approach is going to be, we're going to use Bitcoin to continue to grow. And what that means, we'll talk about more in the future, but everybody knows we have a line of credit that's backed by Bitcoin, single digit interest. It's a revolver. We can use it when it makes sense and pay it off. We've talked about the fact on our earnings calls that there will be a time in the future that we maybe sell a percentage of our production. We're going to hold on to the HODL, because of our underlying thesis on Bitcoin. But I think going forward, you may see us be more pragmatic about growing the HODL instead of 700 coins a month, maybe 300 or 400 coins a month, and using the balance of that production to offset OPEX and to put some of that towards CAPEX and to manage the debt that we have. Again, trying to be the grown up in the room and run it like a proper business.
Man, I love to hear that. That's been part of my thesis for CleanSpark, and the markets they don't see it right now. As CleanSpark continues to grow, they can start to use a small fraction of their production, sell that small fraction to fund the business and to fund the growth, and they can start to earn that yield on their HODL balance. So it's great to hear the management team actually kind of vocalize this a little more. I felt like I was kind of just in my own little world almost, kind of trying to create a bull thesis. The management team themselves haven't talked about it much until today, so this gives me some confidence that they're making some headway when it comes to earning this yield on their HODL balance and really maturing as a business. And the days of heavy dilution might be over now. There ATMs in the future, absolutely there could be, but as you just heard Matt say, not with the valuation sitting where it is.
Yeah, on that sort of last point you made, I mean, historically, CleanSpark has taken an opportunistic approach with regards to its Bitcoin holdings. And how would you consider selling down some of your Bitcoin stack here to fund future growth, like when we're talking about past 50 exahash and so forth?
So we're pretty well positioned, and Zach and Gary both talked on our last earnings call. They used the phrase exit velocity, and what we mean by that is we've now reached the point that we can continue to grow our stack and sell a percentage of our production to offset the CAPEX needed for growth. So we have a lot of flexibility there. The cool thing is with the Bitcoin backed line of credit, we don't have the tax impact. I mean, we're mining Bitcoin at 30,000. We start moving that Bitcoin into the market at 85. Now we're paying taxes on it. It makes it all that much more difficult to regain those sats that we sold to cover short-term CAPEX. So I think you're going to see us use debt that's secured by Bitcoin on an increasing level, continue to explore the bond market, even potentially look into baby bonds. I think we're going to be flexible. And will there be a time that we use, equity again? Certainly. I mean, that's why every company is public. But at this valuation, I think it's safe to say not in the near future.
You kind of talked about this or alluded to it or briefly mentioned it throughout this conversation. And I met with Rory on your team yesterday. It was great to meet him and what what you're doing there. But last quarter, CleanSpark mentioned you're gathering RFPs to explore yield generation options for your Bitcoin holdings. And so I just want to see if you can elaborate on any strategies that are being considered and the potential for developing additional revenue streams that aren't dependent on hash price.
Yeah. So keeping it in the domain of what's already been publicly discussed, we've developed a digital asset management team. We have a strategy. We circulated 19 RFPs for counterparties. We slimmed that down to about 9 companies that we would work with. We're looking at companies that could partner with us on Bitcoin holding, on treasuries, on derivatives, on a number of different strategies. But you had an opportunity to meet Rory. I mean, I feel like I'm surrounded by really smart people, and then he starts to talk, and I feel like I'm in middle school. There's just a level of the I think how far in the future he thinks and the value he gives to everything from vol to market conditions to energy costs. And he presented to our board a strategy that involves using this trading component of our company to generate yield, but not just based on the price of Bitcoin, based on global hash rate, based on the price of energy, based on global and geopolitical events. And they have a number of levers to pull. And it's such a thoughtful approach. I mean, there are Bitcoin miners right now that have a hodl that are lending out Bitcoin unsecured for a 6% return. That looks great for a period of time until it's not secured and doesn't come back. Much the same that forever, not forever, but for the last 7 months, it's been really kind of in vogue to talk about Bitcoin yield. Well, when you're now leaning hard into equity and Bitcoin is flat or down, yield vaporizes. And so now it's no longer part of a monthly discussion. And investors aren't stupid. You can't say this is a measurement criteria that I'm going to use as long as it's my.
I love that. I love it. I love it, man. Mara jumped on board with Michael Saylor's, Bitcoin standard, and they were all gung-ho about their Bitcoin yield for shareholders until their Bitcoin yield went negative. Now, all of a sudden, they don't report it anymore. Like Matt said, investors aren't dumb. Actually, he said investors aren't stupid. I love it.
Favor, but as soon as it shifts, we're not going to talk about it anymore because people don't have that. They're not that short-sighted. So I think, being disciplined with that treasury management strategy, generating a legitimate yield. I mean, on $1 billion worth of Bitcoin, if you make 3% a year, that covers a significant portion of your annual OPEX. So, we're not swinging for the fence. The way that Gary and Rory presented it was a crawl, walk, run strategy. And I think you'll start to see that roll out.
Yeah, I never got the whole Bitcoin yield term for just increasing Bitcoin per share, but that's been how we present it. But yeah, I mean, it's another way to approach it, I guess. How do you view, I guess let me just wrap this up. We got a couple minutes left, and thank you guys for staying. It's been a good conversation, Matt. How do you, when you make the investment case for owning a miner like CleanSpark versus alternatives, owning Bitcoin outright, owning ETFs, what is the case that you make for the investment case?
So I think owning Bitcoin outright or buying an ETF is strictly predicated on the price of Bitcoin. So if you're making an investment based on a thesis that the world's hardest money is going to appreciate over time and your expectation is to generate a return on that investment, it's a great place to go. We like to think of ourselves as a disciplined leverage play on Bitcoin because, as reported in our last quarter, our cash cost to mine of Bitcoin is about 30. A lot of pent up demand, and we get a lot of inbound from hyperscalers because of the fact that we have those relationships that I talked about. Finding, sourcing, and securing power is an art form, and we have a team of guys that have used our history and our reputation to get invites to use power rather than make requests to post up somewhere. So I think you have exposure to what we believe the best Bitcoin mining operations in the world. We've taken extensive consideration to counterparty risk, to managing our HODL, to our yield generation from Bitcoin trading, our energy relationships, the efficiency of our fleet, even something that seems as benign as the relationship between a small city. College Park, Georgia, there's a corner of a little piece of power, a little piece of real estate, and some power that's excess. They didn't call hyperscaler. They called CleanSpark and say, hey guys, when can you be here? So, I think what you're getting when you invest in a company like CleanSpark is a disciplined and thoughtful approach to a leverage play on Bitcoin.
Thank you, Matt. This has been great. Appreciate you.
Thanks for your time.
All right, there you have it. There was the whole conference. Unfortunately, we couldn't watch it live, and the replay popped up after the hour, so we sped through it there. Actually, some really good information, and I can't wait to hear more about them earning return on their HODL balance. It seems like there's some advancements happening there, which makes my day, because that's been part of my thesis for the company. People said I'm crazy to have that thesis, but now it looks like the management team is actually moving in that direction that I did a live stream not long, I guess a couple months ago, talking about CleanSpark's master plan, how just like Matt said, earning a 3% yield on $1 billion HODL balance covers significantly, if not all, of your operating expenses. And if you're offsetting all of your cash expenses at the company via HODL yield, real yield on your HODL balance, that enriches, that benefits shareholders tremendously. And then your mind can go all over with what happens next. You know, when that yield can turn into something more than just covering the cash expenses of the company. What if, at the end of the day, they're bringing cash to the bottom line of the company? Well, they can use those retained earnings to plow back into the business, to grow the business even further without diluting or taking on any debt. Or maybe it's shareholder distributions, or when I say that, I mean more of a share buyback program. Now, I'm talking 3, 4, 5 years down the road here. This is still very, very young, but it's such a promising future. And for me, it's easier to see this play out in a way that benefits and enriches shareholders much more than I can see the HPC AI arms race play out in a way that enriches and benefits shareholders, at least to the same tune of what we're talking about here. I don't see a scenario where the ROI on AI HPC, at least right now, is greater or better than what you can do with Bitcoin mining. A lot of that will come from the HODL yield and, of course, Bitcoin's price appreciating. But this arms race of having to purchase new GPUs every 2 years, and you're never ever going to fully pay those GPUs off. But those companies say, well, we have 90% margins. Yeah, but you're not paying off your investment. So I'm not seeing any of those margins on the bottom line, or my claim to those margins. I don't have any earnings as a shareholder at the end of the day that I can claim, despite your 90% margins, because of the shiny keys you're chasing. That's not a viable business model, in my personal opinion. Now, I'm gonna, if I was on the CleanSpark management team, I would write all of these other competitors a letter. I'd title it "Thank you for leaving the Bitcoin mining space," because it allows my company to continue to expand my footprint, to continue to control more and more and more of the total Bitcoin network hash rate over time. And the opportunities with that are endless as well. They talked about, just a small example, they talked about how they're Bitmain's largest customer right now. That gives them room to negotiate with Bitmain. Bitmain has a lot of respect for them. The future is very, very bright, and I actually thought this conference was a very, very good one. Usually, whenever Matt talks, it's a good time. But we actually got some value out of this conference. I'm not sure why they PR'd it or press released it just an hour after market close. If I were them, I would have wanted everybody in the crypto sphere to know that this was happening, to know that I was talking at this conference, but for whatever reason that didn't happen. Maybe it was just an impromptu thing that they couldn't PR it this morning or earlier in the week. I'm not sure. But anyways, we've been going for 2 hours now, guys. We had to wait for the replay to be posted, then we watched through the replay. My confidence in CleanSpark is unchanged. The market can do whatever it wants to do. In my opinion, just based on the company's operations, the execution there by the management team, they're doing everything in their power right now to help the share price out. But when we're in market climates where people they're selling everything left and right without giving any thought to these companies and their operations, there's very little that the management team can do. So I like to, as an investor, focus on the things that matter: operations, profits, execution. And when the bull market comes and the risk-on market comes, I firmly believe my investment here is going to return me lots and lots and lots of capital. Just has been the case several times over the last 6 or 7 years. I don't see how that changes. Now, I know people are just, whenever you're thinking about selling a company, always think about the operations first, because so many people out there are just they see the market fall and they're just gonna go sell their companies without giving a second thought to it, because the markets are falling, and they forget that, oh, I don't own lottery tickets, I actually own a company. And then they regret that when the stock price actually ends up recovering. They ended up buying back in at higher prices. And they end up actually enriching the shareholders that held through those dark times and were buying more during those dark times. Just the way things work. But don't fall into that trap. Now, if you look at the operations and the management team and the company and see a failing business, that's another story. But I just don't see that. And I think you're kind of crazy if that's what you're seeing right now. Based on almost any metric you look at, the company is healthier than it has been, maybe in its history, with the exception of when Bitcoin was at $100,000 plus just a couple of months ago. Anyways, I'm going to end this stream here. Thank you guys all for hanging out with me. I'll leave the replay of the conference call up, but I'm going to cut that first hour out of it because we just kind of went on a rampage about the markets and specific stocks. So not much value there, but I'll leave the replay of the conference up if you want to re-listen to it or you're just joining. You can go watch the first part of it here. But thank you guys so much for tuning in and have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.